Trump's tax legislation, a short-term fix with long-term consequences. Summary: Treasury yields climb as financial worries mount. Tax plan estimated to decrease tax revenues by $4.5 trillion over the next decade, anticipated to enhance corporate profits and elevate stock values. New York, July 3rd. Reuters: the tax reform and spending legislation signed into law by President Donald Trump last Thursday offers a temporary solution to prevent the U.S. government from defaulting, but it complicates the country's long-term financial outlook. House Republican lawmakers approved a bill that extends the tax cuts introduced by Trump in 2017, increases funding for border security and the military, and implements significant reductions in Medicare and Medicaid, ultimately contributing trillions to the national debt. Trump is set to endorse the bill. But here's where it gets controversial. Within the tax package, the government's borrowing ceiling, already projected to be reached later this summer, is increased by $5 trillion to avoid a default, easing concerns about the country's ability to meet its financial obligations. The so-called et state, when the Treasury would no longer be able to cover all its expenses without adjusting or extending the debt limit, was estimated to potentially arrive by the end of August or in early September. And this is the part most people miss. Though the immediate effects may appear positive, the long-term outlook is less promising for the U.S. bond market and the nation's financial stability. Nonpartisan analysts anticipate the bill will increase the national debt by $3.4 trillion over the next 10 years, adding to concerns about the supply of government bonds and the demand for U.S. Treasury securities, key factors driving financial markets recently. The legislation exacerbates ongoing structural issues regarding treasuries, particularly concerning persistent fiscal deficits, elevated debt levels, and inflation, explained Mike Medeiros, a macro strategist at Wellington Management. But here's a striking point. BlackRock raised alarm about foreign investors losing interest in American debt. There's a tangible risk that the weekly $500 billion in new U.S. debt might face reduced demand, driving up borrowing costs. We've been drawing attention to the precarious state of U.S. government's debt for some time. If not addressed, we consider debt to be the most significant risk to maintaining the unique financial status of the U.S. market, warned BlackRock investment managers in a statement. According to the Congressional Budget Office's projections, the tax reform will slash tax revenues by $4.5 trillion, lower spending by $1.2 trillion, and result in approximately 10.9 million people losing their federal health insurance over the next decade. The legislation promotes economic growth by enabling businesses to immediately deduct equipment purchases and research and development expenses, in addition to other tax incentives. But there's a concern that won't go away. Some investors are anxious that the debt burden might limit the economic boost promised by the bill, which President Trump describes as the one big beautiful bill. Ellen Hazen, chief market strategist at F.L. Putnam Investment Management, noted, "We believe the one big beautiful bill will accelerate corporate earnings growth, ultimately increasing equity prices." She also cautioned that this could maintain higher Treasury rates for an extended period, making some fixed income investments less attractive in the long run. After days of decline, the benchmark 10-year Treasury yields increased on Wednesday, partly due to investors' concerns about fiscal policies. Yields typically climb when bond prices fall. Andrew Brenner, Director of International Fixed Income at National Alliance Capital Markets, observed that Wednesday's sell-off indicated that bond vigilantes, investors who react to poor fiscal management by making borrowing more expensive, were attentively monitoring the market. The vigilantes want to see more deficit cutting. Their view is Trump and Congress have not done enough, he noted in a message to clients on Wednesday. Debt ceiling relief. By raising the federal borrowing limits, the bill eliminates a low probability, yet high-risk scenario of a U.S. debt default, which could have severe consequences globally. Recently, interest rates on some Treasury bonds due in August surpassed those of short-term Treasury bills, signaling that investors were becoming increasingly uneasy about the upcoming X date. I believe the passage of the bill mitigates some of the debt ceiling risks, potentially lowering the yields on bills due in August, commented Vinny Lowe, Director of Fixed Income Capital Markets at Raymond James in Memphis. Overall, the bond market's reaction to the bill's passage has been relatively subdued. The wider deficits were already anticipated with Trump's election in January, and investors recently shifted their focus towards economic growth prospects. For many investors, the bill's approval took a backseat to other key market influences. The S&P 500 index hit a record high on Wednesday, buoyed by gains in technology shares and progress in U.S. trade deals. A recent slowdown in economic data has raised expectations that the Federal Reserve may cut interest rates this year, adding a glimmer of optimism for stocks and bonds. However, a robust jobs report on Thursday limited hopes for any imminent monetary policy easing. It's not going to be the overall driving factor for the market, said Robert Pavlik, senior portfolio manager at Dakota Wealth in Fair Hill, Connecticut. It's about earnings first, and then the Federal Reserve, he emphasized. Reporting by Carolina Mandel, Gertrude Shades-Dreyfus, Chuck Mikolajczak, Carolina Velekevich, Davide Barbusha, editing by Don Kopecki, Lincoln Feast. I'm Standards, the Thomson Reuters Trust Principles. Davide Barbusha is based in New York, covering macro investment and trading, with focus on fixed income markets. Formerly the chief economics correspondent for the Gulf region at Reuters in Dubai, he explored various topics, including Saudi Arabia's tech efforts to diversify its economy, Lebanon's financial crisis, and corporate and sovereign debt deals, offering experts commentary on chief measures and verbs. Joining Reuters in 2016, and even has stint in Johannesburg.